I think it's so important that we educate our listeners, our clients, everybody, other realtors on really the different packages going out there. So now there's a special program for investors, right? Non-owner occupant for investors, right? Buying multifamilies, or is this owner occupied as well?
Well, we have different options here. I mean, obviously, you talked about investment properties first. I want to let everyone know out there that, in this market in particular, investment properties prices are very high, but also rents are going up, at a tremendous rate daily. And there's a big need here for housing. So if you're an investor, obviously there's many options you have that are available to you. Most people out there, like to go with, conventional financing is obviously the preferred method for most investors who, if the numbers work on paper, obviously those are, looking at tax returns, W-2s, pay stubs, and that will work for some people. Obviously not downplaying it. It's a great option there. But there are many investors out there, as you know, that maybe not the most traditional when it comes to, showing income, claiming income. So we have to be more creative to get the financing to work. And so with those investors, really what I want to focus on in particular today. And in this market, like I said, we have programs out there. The investor cash flow, the DCSR loan, DSCR loan is a great program. Basically, this program is for people who maybe have numerous investment properties in their portfolio, and on their tax return, their Schedule E, where they claim rental income, maybe they have write-offs, which most people do for repairs, for different expenses they incur with keeping up with the investment properties. So for them, their tax returns might not look the bottom line might not look as strong as what they really are. So we have a program where we look at a property, let's say a 3-unit property in particular, and let's just say the property fair market rent is $2,000 per unit. We'll take the 3 units, let's say $6,000 total times $2,000 a unit, and we'll take that number as long as the mortgage that you're going to apply for, the principal, interest, taxes, and insurance is less than what the rent brings in. You're qualified. You need at least 20% down, which you would agree most investment properties, people who are buying them have to put down at least 20%. That's very common, 25%. So 20% down, you can go as low as 620 credit. So, I mean, imagine that. 620 credit score, you can sometimes go with 20% down and will qualify you solely on the property you're purchasing, looking at just rental income, either fair market rent the appraiser determines, or we'll go by lease agreements that are in place at that particular property. And this is something for, any investor who is interested. We can actually, do numerous properties, and each time we only look at the subject property you're purchasing. So you can buy 5, 6, 7 properties over the course of a few years, or even in 1 year. And that's how we look at income. It's a great opportunity. I mean, hard money's out there as well, but usually the terms might not be as advantageous. So this is for someone, and the rate typically is consistent with what you would pay for a normal conventional rate on an investment property. So it really isn't outside the box. To me, it's a no-brainer for people, especially who, want to buy numerous properties in a short period of time and, need to show more income on their tax returns. But this is a way around that in the short term. So it definitely is an option. I wanted to mention today and something else, Emilio, that, I think might be really important is for owner occupied now, starting this week coming up with conventional. Used to be the rule with, if you're looking at investment, a multifamily property, right, owner occupied, you were going FHA 3.5% down. That's pretty common. That a lot of the offers are being accepted, but sometimes you have issues with what's called a self-sufficiency test, where the rental incomes, weren't enough to cover, that they have basically a kind of a formula. You'll take for a 4-unit property, for example, you'll take fair market rent for each unit, you multiply it by 75%. And if that number is less than what your monthly payment will be on the mortgage, you would fail the self-sufficiency test with FHA loans. So basically you'd have a 3-unit property, 4-unit property where rental income were okay, but because prices are so high, rates are a little bit higher than we're used to, it would fail. So now a lot of times you'd have that middle of a transaction. They'd qualify on paper with, obviously income, down payment, credit score, and then all of a sudden this test would fail. So now we have, starting this week with conventional, 5% down for multifamily homes. And I looked at pricing the other day and honestly, it's very consistent with what FHA is offering. The hits, they call it LLPAs, the loan level pricing adjustments, are very minimal. And people can, qualify for this program coming out this week. So keep that in mind too. 5% down, conventional financing for multifamily homes, and you don't have to be a first-time home buyer. So it's definitely an opportunity as well coming up.